When it comes to buying a home, one of the biggest questions on a buyer's mind is often this: what credit score do you really need to qualify for a mortgage? Many potential homebuyers assume that perfect credit is a must-have. The idea of needing a flawless score can feel intimidating and even discouraging. The good news is that perfection is not required. Understanding what credit scores lenders look for, how those scores are calculated, and what steps can be taken to improve them can make the dream of homeownership much more attainable. First, it's important to recognize that different types of loans have different credit score requirements. Among the most popular loan programs for first-time and repeat buyers are FHA loans. These loans are backed by the Federal Housing Administration and are designed to help buyers with less than perfect credit or smaller down payments. FHA loans accept credit scores as low as 580 if the buyer can put down at least 3.5% of the purchase price. For those with scores between 500 and 579, FHA loans may still be possible, but a larger down payment of at least 10% is usually required. This flexibility makes FHA loans an option for many buyers who might otherwise assume they are out of the running. Conventional loans, which are not insured or guaranteed by the government, generally have stricter credit requirements. Most lenders expect a credit score of at least 620 to approve a conventional loan application. However, to qualify for the best interest rates on conventional loans, buyers typically need a credit score of 740 or higher. This distinction is important because while a score of 620 might get a buyer approved, the interest rate, and therefore the monthly payment and total cost over the life of the loan, will be higher. Higher credit scores translate directly into savings, sometimes tens of thousands of dollars over 30 years. For veterans and active duty military members, VA loans offer an excellent path to homeownership with no down payment required. There is no official minimum credit score for VA loans, but most lenders look for scores in the 580 to 620 range. Similarly, USDA loans, which are designed for rural and suburban homebuyers meeting certain income guidelines, do not have a firm minimum score. Still, lenders typically want to see a score in the same 580 to 620 window before they will approve a loan application. These programs provide alternatives for buyers who may not meet the conventional loan credit score bar, but still aspire to homeownership. One of the most common misconceptions about credit scores is relying on the numbers seen on free consumer apps like Credit Karma or others that offer instant score updates. While these tools can be helpful for general credit monitoring, the scores they provide are not the ones mortgage lenders use. Mortgage lenders rely on specific versions of the FICO score, namely FICO 2, FICO 4, and FICO 5, which are mortgage-specific scoring models. These scores can be 20 to 40 points lower than the scores shown on consumer apps. This gap means that a score of 640 on Credit Karma could translate to something closer to 600 when a lender pulls the mortgage-specific scores. For this reason, it is highly recommended that prospective buyers obtain their actual mortgage credit scores from a reliable source such as myfico.com before starting the home loan application process. Knowing the real score helps avoid surprises and allows buyers to plan accordingly. Understanding what factors influence mortgage credit scores is crucial for those looking to improve their numbers. The largest single factor is payment history, which accounts for 35% of the score. Timely payments on all credit accounts, including credit cards, loans, and mortgages, establish a track record of reliability that lenders value highly. The second most significant factor is amounts owed, making up 30% of the score. This refers largely to credit utilization, the ratio of credit card balances to credit limits. Keeping revolving balances below 30% of available credit is a proven strategy to boost scores. Length of credit history contributes 15%, so maintaining older accounts and avoiding closing long-standing credit lines can benefit the score. New credit and credit mix each account for 10%, meaning that applying for multiple new accounts just before applying for a mortgage can hurt the score, and having a healthy mix of credit types, such as installment loans and revolving credit, can help. Improving a credit score is often a matter of consistent, disciplined financial behavior over time. Paying down credit card balances to reduce utilization is a straightforward, effective step. Making every payment on time is critical. Even one late payment can cause significant damage. It's also wise to avoid opening new credit accounts in the 6 to 12 months before applying for a home loan, as new inquiries and accounts can signal increased risk to lenders. Buyers should also review their credit reports carefully and dispute any errors or inaccuracies, as mistakes can unfairly lower the score. These steps are part of a strategic plan to enhance creditworthiness. The timeline for credit score improvement varies depending on individual circumstances. Meaningful improvements can often be seen within 3 to 6 months of taking targeted actions like paying down balances and correcting errors. More significant score gains, especially for those starting with lower scores, may require a year or more. Patience and persistence are key, as rushing into a home purchase with a suboptimal credit profile can mean higher interest rates and less favorable terms. Ultimately, the relationship between credit score and mortgage interest rates is powerful. Even a small increase in credit score can result in a noticeably lower interest rate, saving thousands of dollars over the life of a loan. These savings can make a substantial difference in overall affordability and monthly budget flexibility. For buyers, investing the time and effort to understand and improve their credit score is one of the smartest moves on the journey to homeownership. In summary, perfect credit is not a prerequisite to buying a house. FHA loans open doors for scores as low as 500 with the right down payment, while conventional loans usually require at least 620, with the best rates going to those above 740. VA and USDA loans offer additional options with flexible score requirements. Buyers should focus on their actual mortgage credit scores rather than consumer app estimates, and prioritize improving payment history, reducing credit card balances, avoiding new credit, and disputing errors. With dedication over several months, credit scores can improve significantly, unlocking better loan terms and substantial savings. For those ready to take the next step, the Ultimate Home Buying Guide offers a detailed 24-month countdown plan that covers everything from credit preparation to closing day. The guide is designed to empower buyers with the knowledge and tools needed to navigate the home buying process confidently. The link to the guide is in the description below. Your path to homeownership starts here. To stay updated with more expert insights on homeownership, subscribe to the channel.